All right, so this is our last lecture here to cover the rest of chapter 2 in the accounting cycle. So we just finished up going through all the adjusting entries, and so now we're going to kind of take that all the way through the closing process and do a little bit of comparison between cash and accrual accounting. Hopefully, we were ready for the first test. And so step 7 here, we're just kind of going to jump into it if we can. All right, so now we're going to take everything we've done. So we have all of those external activities, which were our normal journal entries. Then we went to our our unadjusted trial balance. Then we did our adjusting trial entries. And now we're going to kind of take all of that information and we're going to create our adjusted trial balance. And so we'll have captured all the internal and external activities for the whole period, for the month of January in this case. So whenever we present those adjusted trial balances, the order does matter. So we're going to go sort of that same order as far as the numbering, hundreds, 200s, 300s, 400s. And so we start with our assets, liabilities, permanent equity accounts, then our revenue, then our expenses, and then dividends. And so that's the order that we'll present them in our adjusted trial balance. And so all we're doing is we're taking all that information from the T accounts, summing it up, and now we have our adjusted trial balance. And so the cash balance didn't change. Receivables didn't change, but supplies, prepaid rent, prepaid advertising, they all changed. And then we have this new account called accumulated depreciation. And notice again that it's a contra asset, so it has a credit balance. Every other asset account has a normal debit balance, but the accumulated depreciation is a contra asset, and so it's going to have a credit balance. And you're going to see where that plays out in the financial statements here soon. So again, when we present our adjusted trial balance, it's debits and credits, and we don't have pluses and minuses. It's debits and credits, and so we have our debit column and we have our credit column. And then when we turn our attention to the other accounts, we can see that we have our liabilities and our permanent equity accounts payable. Salaries payable is a new one. Interest payable is a new one. The others are there. Notice that retained earnings still has a 0 balance. We have not done anything with that account yet. We're going to get there soon. And then we have all those temporary accounts, our revenue, expenses, and dividends. And again, revenue is a normal equity account, so it has a credit balance. And then everything else is a contra equity account. And so they all have debit balances. Again, kind of the big changes here, salaries expense now includes both the January 15th and the adjusting entry. And then the supplies expense was an adjusting entry. Rent expense was adjusting entry. Advertising expense was adjusting. Actually, all of these except for dividends were all part of our adjusting entries. And so if we hadn't done the adjusting entries, of course, our expenses would have been pretty grossly misstated. So that's why it's an important part of the process. But this part's pretty easy, honestly. It's just summarizing. So you're just taking the account balances from the T accounts and throwing them into 2 columns here. All right, so now that we've sort of caught up everything, we're going to kind of go into our financial statements. And I apologize, but this step 8, I think it's my picture might be blocking it. All right, so we got our four main financial statements. Of course, we got our income statement, balance sheet, statement of cash flows, and statement of stockholders' equity. So those are the 4 main statements that we walk through. Starting with the income statement, really what we're trying to capture here are those profit generating activities. If you remember, we talked about revenues and expenses as being sort of the context is over time, and it's really capturing the company's ability to create resources essentially, or create profits. And so revenue captures the economic increases from our operating activities. And then expenses are what we consume, or measuring how we consume resources in order to generate those profits. And so the income statement captures that over a period of time. In this case, it'll be obviously just the month of January. And so the 4 types of accounts you're going to see on an income statement, revenues, expenses, gains, and losses. And again, remember, elements include assets, liabilities, permanent equity accounts, revenues, expenses, gains, losses, and dividends. Those are all the different elements identified by the conceptual framework. And this is the statement where we present the revenues, expenses, gains, and losses. And so what we're looking at again is we're looking at the change in equity, or the increase or decrease in equity from the operations of the company. If you remember the contributions from owners, that was paid in capital. And so this is sort of that other piece, except for dividends, of course, that's going to come. but all of these roll into ultimately retained earnings, and you're going to see sort of how that plays out. There is something called the statement of comprehensive income, which is a little bit broader as far as a measure of income. With an income statement, we stop at net income. Comprehensive income includes some other things, and we call those other items other comprehensive income. And again, it's a secondary measure. It is not something we're going to cover in this chapter. You're going to see it a little bit here and there, and especially in later intermediate accounting classes. All right, so let's talk about the income statement. So of course, we start at the top with the financial, with the name of the company and then the name of the statement. And notice the format of the date, it's trying to just capture the fact that this is measuring economic activity over a period of time, and in this case for 1 month. And so at the very, very top, we have our sales revenue and then our cost of goods sold, and that results in this sort of intermediate measure of income called gross profit. And of course, hopefully we know what revenue is. Those are the wealth or the resources that we've collected or increased from our operations, from sales. And then cost of goods sold for this company was the cost of their inventory. And if you recall, it's just the cost of what it cost them to acquire it. So they bought inventory and then they would sell it. And so that cost of goods sold is meant to kind of capture the direct costs. And so a lot of times when you talk to a CEO, COO, maybe even a CFO, they're going to talk about their margins. Oh, my margins are 30%, my margins are 50%, my margins are whatever. This is really what they're talking about, is their gross profit. And so, and we're going to get later on in other chapters, we're going to get into how we measure financial performance using ratios. And one of them is this, sort of gross profit margin or profit margin, or gross margin or gross profit margin. And so, it's an important measure for how efficiently or what your markup is on your inventory. And it's capturing those direct costs of actually procuring the inventory and figuring out how much you're marking things up. And then the next section is all of those operating expenses. And so these are activities, activities that consume resources, but aren't direct to the material that you're selling or the inventory that you're selling. So we have our salaries expense, supplies expense, rent, advertising, depreciation. All this captures the fact that we are consuming resources in order to operate. So these are things that we need. We need to pay employee salaries. We need to have supplies. We need to have space to operate in, but they aren't direct. They're indirect expenses. And one thing I do want to highlight here is that, if you think about salaries expense versus what I would call like a salaries cost, it really does depend on the type of company. So as an example, this is probably pretty good for like like Walmart or, something like that, where, it's pretty much you buy inventory and then you sell it. For someone like a manufacturer, this does get a little more complicated. And the reason that it gets a little more complicated is because cost of goods sold tends to capture a little more than just the purchase of inventory. Because for a manufacturer, they're actually creating inventory. And so you might have raw materials. So like if I'm a car manufacturer, if I'm Ford or something like that, you've got the plastic and the steel and the glass and the rubber tires. And then you've got the cost of everyone who's operating the machines that actually assemble the vehicle. And then you've got the foremen who oversee them. And you've got maybe the plant managers or the line managers. And then you've got, just the cost of maintaining the facility, the cost of the equipment inside the facility. You got all these different costs, and some of those costs might be salaries. Some of those costs might be supplies. Some of those costs might be rent. And some of those costs might be depreciating a piece of equipment. But in that circumstance, because they're all sort of directly involved in creating a car, they're going to be all part of cost of goods sold. And so for manufacturer, this statement is a little more nuanced, and you got to be a little more careful about how you report things, because one person's salary may be part of cost of goods sold, but another person's salary could be salaries expense that's part of your operating expenses. And sometimes then it starts to be known as SG&A, selling general and administrative expenses. And so like the CEO salary would be operating expense. A foreman's salary is going to be cost of goods sold. Supplies, if I'm using supplies in the factory, cost of goods sold. If I'm using supplies in my headquarters building, operating expense. And so it just depends on where that cost is as far as how you classify it. So there's a little bit of nuance here, but obviously for this class, if I say salaries expense, I mean it's an operating expense. I'm not expecting you to roll it into cost of goods sold or anything like that. But I am saying you need to pay attention to this, because as you get further into your accounting or finance career, understanding that nuance becomes more and more important. And so all that to say, though, this operating income for a lot of companies, this is what I would say is their primary measure of income. In other words, when they think about, are we profitable? How are we doing in terms of profitability? A lot of times this is the measure that they will focus on internally. And so operating income, these are sort of those core things that we have to do in order to continue to operate our business. And are we profitable at doing them? And probably more importantly, how profitable are we at doing those things? But beyond operating income, we do have some other items. So, other income and expenses are, interest expenses. The example that we have, you could have gain on sale, loss on sale, interest revenue. There could be some other things in there as well. Those are kind of the main ones. But a lot of times, maybe a one-time expense might be thrown in there. Notice that, up above, cost of goods sold is listed as a positive number. But we know that, clearly there's a subtraction going on here. And the reason why we do that is because everyone knows that when you list cost of goods sold, you are reducing sales revenue to a lower number to get gross profit. And so we don't have to put pluses and minuses because we know that it's a minus. Similarly, when we talk about our operating expenses, these are all pluses, all positives, because we know that in total, all of this is going to be subtracted from our gross profit in order to get our operating income. It's a little more ambiguous when we get to other income and expenses, because in this section, income-related items would be an increase to our income, whereas expense-related items are decreases. And so because it can be both, you actually need to list that as negative. If it were interest revenue, it would be a positive number. And so just a little nuance to pay attention to. But you can see that in total, net income for 400 Company was $2,344. All right, so now the balance sheet. The income statement is over a period of time. The balance sheet is measuring a financial position at a point in time. So in other words, we're looking at what are the resources that we have? What are the claims against those resources at a very particular time, whether it be liabilities or permanent equity accounts? We're measuring everything at a point in time. All right, so one important thing when we talk about the balance sheet is that it is permanent accounts that we're focused on. Hold on one second. All right, sorry about that. We just had some background noise that was getting really, really loud. All right, so when we have our permanent accounts on the balance sheet, of course, that's assets, liabilities, and our permanent equity accounts. And the balance sheet is going to report all that in one place. And so as we do that, oops, sorry, let's click back on here. Let's present that. And we can see, first of all, the date format has changed. In other words, instead of measuring income over a period of time, a balance sheet is taking account balances at a point in time. And so it's as of 1/31/2022. The first thing we're going to list is our assets. And the first assets that we list are our current assets. And of course, we're taking all these balances from the adjusted trial balance. And as you remember, we list our current assets in order of liquidity. We kind of talked about cash and receivables being the first two. Short-term investments sometimes might go in between the two. But in this case, we didn't have any short-term investments. And then after that, honestly, it gets pretty flexible. But these would be sort of the next four. Normally speaking, whatever numbering order you use, that's probably the order you're going to follow here, just in general. But you can see it's kind of order of liquidity, and that gives us our total current assets as of the end of January. In this case, we have very few non-current assets. In fact, we only have one, and that is our office equipment. Notice that the balance in the office equipment is still listed at $20,000. We haven't changed that balance, but now notice that that contra asset is listed as a negative. And so whenever you report assets on the balance sheet, contra assets are reported as negatives. If you had a contra liability, it would be reported as a negative. Or if you had a contra equity account, it would be reported as a negative. And so the accumulated depreciation on the adjusted trial balance has a credit balance. And here that credit balance shows up as a negative account balance on the balance sheet. And then of course we total everything up and we have total assets of $232,494. And then the rest of the balance sheet is the other half, liabilities and shareholders' equity. Current liabilities, if you remember, we generally report them in the order of frequency. And so with accounts payable, that is usually the most frequently used account. And then, salaries payable might be once a month. Interest payable is probably once a month. Note payable, in this case, is once every 9 months. And so generally it is in that order of frequency. And also it would be sort of the numeric order, again, that we used in our accounting system, our post-reference number. This company doesn't have any long-term liabilities, so that made this one kind of easy. When we get to chapter 2, you're going to see, some non-current liabilities as well. And on the shareholders' equity side, again, common stock is taken right out of our adjusted trial balance. We do have 30,000 shares issued and outstanding. That's a normal disclosure on a balance sheet. It's just information that's shared. One thing I want to highlight, though, and we'll kind of go back and forth a little bit, is look at the balance in our retained earnings account. It's $1,744. But if we go back to our adjusted trial balance, if we get there somewhat soon, you can see that the balance in our retained earnings account is 0, right? So from the adjusted trial balance, the balance is 0, yet when we report it on the balance sheet, it's 1,744. And the reason why it's 1,744 is because the balance sheet is meant to capture retained earnings basically post-closing. In other words, after accounting for the process of accumulating earnings and distributing dividends out of retained earnings, we want to now report that balance on the balance sheet. And so when we start with a 0 account balance, and as you remember probably from your statement of retained earnings, we add net income to that. And of course, in this case, net income is 2,344. And then we subtract dividends, and dividends were 600. So 2,344 less the dividend, that's how we get 1,744. Again, that would be our 0 starting balance plus net income. If I can write this over here, this is a little tricky, and then minus the dividend for those of you that want to go back and forth. And so that is how, again, that's 0 is our beginning balance. Now in February, our beginning balance wouldn't be 0, it would be 1,744. And so again, we just sort of accumulate that balance in our retained earnings account, and everything balances out because our total liabilities and equity and our total assets are exactly the same, 232,494. All right, statement of cash flows. For most students, this is kind of a new one. And so maybe we're not going to go slow, but we'll kind of be a little more careful. But we're going to present kind of the direct method here because I think it is the most illuminating. And then when you cover statement of cash flows, probably in intermediate 3, you're going to be introduced to the indirect method as well. So there'll be a little more involvement at that point in time. But there are 3 sections to the statement of cash flows that are based on the 3 different types. The first one is the operating section. Those are the day-to-day activities. Investing is buying and selling non-current assets. And then financing is transactions with creditors and investors. There is one caveat with the transactions with creditors, and that interest is paid to creditors, but under US GAAP, we treat interest payments as part of our operating section. That's just a little nuance we do in US GAAP. It may change someday, but for now, that's going to be where it resides. And so looking at our statement of cash flows, we're going to kind of walk through the three sections. We're going to start with the biggest one, which is our operating activities. And we separate things into cash inflows, which is cash that we're receiving, and cash outflows, which is cash that we're paying out. And so you can see that we have receipts from customers of $55,900. And then we have different outflows for rent, supplies, advertising, inventory, and employees. And one thing I want us to highlight, this is very important, and I think as an accountant, this is what you need the dots you need to start connecting in order to go from being a bookkeeper to be an accountant and a person who actually is using accounting information. What I want us to do is I want to connect the statement of cash flows to the income statement. And so if you think about receipts from customers, we have listed here $55,900. Those are our cash receipts from customers. Now I want us to go back to the income statement. It's a little bit further back, so I apologize for the number of clicks here. But look at the very top row here, sales revenue, which is really our economic transactions with our customers. And you see here it's listed as 60,900, but on the statement of cash flows, the receipts were 55,900. And what I want us to start seeing is there's a difference between what we see on the income statement and what we see in the cash flows. The income statement is accrual-based accounting, whereas the statement of cash flows is more of a cash-based view of the transactions. And so what we have with this 60,900 is the fact that of that 60,900, 5,000 of it is still outstanding as a receivable, meaning we have not received the cash from that transaction. So while our sales were 60,900, our receipts were only, if I can get there, 55,900. They were not the full 60,900. Similarly, when we talk about those outflows, rent, this is how much we paid for rent. But if you look back at the income statement, you're going to see that the rent expense was only 3,000. So we paid 18,000, but that covers our rent for the next 6 months. And so while the cash flow is 6 months of rent, the income statement, which is accrual-based, captures only 1 month of rent expense. And then payments to supply, similarly, what did we pay versus the income statement is what do we use? Advertising, what did we pay versus what did we use? Inventory, this is a little bit different. What did we pay versus what did we sell, right? So cost of goods sold, it's the cost of the amount of inventory that we sold. Whereas here, it's just what did we actually pay? And this is probably where the biggest difference is, because we only made $8,000 of payments to our suppliers, but our cost of goods sold was substantially higher, I think at like 27,000. Yeah, 27,000. And the reason why we have that big difference is because we still have a big accounts payable outstanding. So we can see our AP is still 37,000. So we haven't paid much for our supplies yet, or for our inventory yet. And similarly with our employees, what did we pay versus how much did my employees work? And in this case, it's a little bit understated, right? Because I only paid for half of the month versus the full month being expensed on the income statement. And so hopefully you start to see why net cash flows from operating activities is a little bit different than net income, because of the differences between what we paid in any given month and how much we actually recorded as revenue or recorded as an expense. Some periods, the cash flow is going to be more than what we accrue as far as net income, and some period it's going to be less. In this case, the cash flow is more, mostly attributed for the fact that, I haven't paid much for my inventory yet. But in other months, it might be less, depending on what's going on. And so on the investing side, not much going on here. The only thing we did there was purchase some equipment. So of course, that's a negative cash flow. And then on the financing activities, there were 3 main things. We did issue stock for cash. We issued a note for cash. And of course, we paid cash dividends. And so in total, that's the net increase in cash. Since we started with a 0 balance, this should equal our ending balance in cash, and it does. But again, this is kind of giving you a picture. And I think the power in thinking through the operating section especially is it's getting your toe in the water to distinguish between accrual-based accounting and cash-based accounting, because they're not the same thing. They measure income a little bit differently. And so I think part of an important role of an accountant is being able to translate that back and forth. And we're going to do a little more of this at the very end. And it's a skill you do need to develop, not only just in this class, but just in life if you want to be successful in this as a career. All right, so the final financial statement is statement of stockholders' equity, 3 columns, usually in principles. If I can find my cursor, usually in principles, you only talk about this column right here, the retained earnings column, but there's a little more going on, not much. But we issued common stock, and of course, we still have what happened in retained earnings. And of course, you've seen this 1,744 before. That was the balance on our balance sheet, and we know where we got that. It's the beginning balance, which was 0, and we add our net income, subtracted our dividends, and that gave us our ending balance. And then the far right column is just a sum total of all of those activities. All right, the final sort of accounting piece here is our closing process. We're going to kind of walk through that. Those are the last two steps here. If you may recall, the closing process is where we take those temporary accounts, revenues, expenses, gains, losses, and dividends, and we need to zero them out to our retained earnings account. And so we're just effectively preparing our financial statements for the next period if we want to start over from zero. So normally speaking, we close all those temporary accounts only at the end of the year. For the purpose of this exercise, we're going to close them at the end of January just to show you the closing process. Again, there's going to be 3 entries typically. So normally you close your revenues first, then you close your expenses, and then you close your dividends. I have seen, and it's okay with me if you combine these last two, but normally speaking, there's going to be at least 2. All right, so when we think about our sales revenue, I want us to kind of highlight this. Notice what we are doing to close the sales revenue account. We are debiting the account for the credit balance. So they had a credit balance. So the adjusted trial balance in sales revenue was a $60,900 credit balance. We are debiting that account so that the balance afterwards is 0. And of course, if we're going to debit the account $60,900, the effect on retained earnings must be a credit to offset it. And essentially, we've now increased our retained earnings account. So after this journal entry, we go from a 0 balance in retained earnings to a $60,900 credit balance in retained earnings. And we're going to kind of see the rest of this play out. But importantly, the sales revenue account balance is now 0. And the retained earnings account balance is now $60,900 credit balance. And so I want you to do, before you go to the next slide, is try to do the next step, which was expenses and losses. So try to close the expenses and the losses to retained earnings. And again, once you've done that, then go ahead and click on this and go ahead, or start over here. And so, of course, hopefully you figured out that because all of these accounts have debit balances, in order to zero all of them out, we need to credit those accounts. And so that effectively every single one of these temporary accounts will be left with a 0 account balance after this journal entry. But one thing I also want to highlight, and we'll kind of draw it over here to the right, is in our retained earnings account. See if I can get this. 60,000, oops. Let's start over there. I think there's a way to clear this. Hey, there's got to be a way. Oh, well. Sorry about that. Let's do it over here. Hey. All right, so we have our retained earnings account. With our previous entry, we had credited that account, 60,900. I am so good at this. And now we are debiting that account, 58,000. Oh, that's tough. 5s are rough. I'm not going to kid you. 556. And then that leaves us a total. If you think about, we have a credit of 60,900 and we have a debit of 58,556. Hopefully you're going to see a familiar amount, which is the net effect of those 2 entries. And so after recording these 2 entries, the balance in our retained earnings is going to be a net $2,344 credit balance. And hopefully that looks familiar. And where that shows up, we're going to click back and then we're going to go back and forth. Way back. It shows up as our net income number, 2,344. And again, because what do we have here? We have the revenue less all the expenses and losses. And so that's where that interim balance in our retained earnings is showing up other places on our financial statement. So when we've closed it this far, now we're at a balance of $2,344. And then finally, we need to close our dividend account. And again, I'm kind of draw all of this. Maybe I'll get it right the first time. So going back to our retained earnings account, we're going to have the 2,344. That is the credit balance prior to this entry. And now notice we are debiting our retained earnings account $600, which leaves us a balance of $1,744. All right. And so that is the ending balance in our retained earnings account. So after we close, the balance in our retained earnings account reflects what was reported on the balance sheet. And again, hopefully that's not too bad, but be prepared to do those closing entries on an exam. And hopefully you can kind of see where this ties into the other financial statements. And so when we update everything, of course, in the closing process, we didn't touch any of our asset accounts. We did not touch any of our liability accounts, but of course, we did update our retained earnings account balance. And notice everything after that, the revenues, expenses, losses, all that dividends, all of that's now zeroed out. So there's no balance left on those accounts. And so they're all gone. And we're going to start over from scratch on February 1st. Again, normally speaking, you close at the end of the year and then you'd start over on January 1st. But in this case, we wanted to illustrate the closing process. All right, final thing. Converting between cash and accrual-based accounting. As I've already hinted to, this is a very important concept in accounting. To be a true accountant, you do need to be able to understand, how do I go from cash to accrual? How do I go back and forth between these two things? For this first test, there are questions on the test, but it's not like you're going to get an F if you don't understand how to do this, because this is a difficult concept for some students. But let's kind of walk through this. And again, so it's a very common practice to see sort of a cash view for operations, but more of an accrual-based view for external reporting. Or sometimes you might be doing cash-based accounting and then you need accrual-based accounting for some specific reason, like you're raising money from private equity, or you're getting ready to, take on a loan from a bank or something like that. And so understanding how to go between the two, and I'm talking both directions, going from cash to accrual and going from accrual to cash, both are important. I'm going to illustrate one direction, but you should understand how to go do both. The other thing I want to highlight is whenever we think about the two systems, cash versus accrual, you cannot change your total income. And what I mean by that is over a long enough period of time. In other words, if I go really, really far out, like years or decades or whatever, whether I use cash-based accounting or accrual-based accounting, the total income is going to be the same, or very, 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 just a small difference. And the reason why is because the two systems differ in the timing of when you recognize revenue or recognize an expense, but they don't change the way you report a total. So it's just timing, not total. And so you get variations year to year, but over a long enough period of time, the totals are going to be the same. So you're not really changing the economics of the firm. You're just changing the way you're reporting them. And so it's just a timing issue. We'll do a quick problem, and then that will be it for chapter 2. All right, so Fortnite Company, they use the cash-based accounting system since it started. They reported $100,000 in revenue in 2019, 135 in 20, and 156 in 2021. And we're just going to focus on revenue. We could do every single account. We're just going to do revenue for now. Now they're being sold to a private equity group. The private equity group requires accrual-based accounting. And so they need to kind of figure out what to do. How do we recast our cash into accruals? And so the information we're going to need is, were there any receivables? So in other words, really that is the accrual account that's related to our sales. Unearned revenue would be the other one, but this company, for whatever reason, didn't have that. They just had receivables. And so we've got to figure out, okay, given that there's a timing difference between accrual-based accounting and cash-based accounting, when we have receivables, that's going to capture those timing differences, and we just have to figure out how to navigate that. So what would be their accrual-based measure for each year? I'm going to do 2019, and then I'm going to pause and let you guys try 2020 and 2021 individually. So let's talk about 2019 first. So we see that the cash-based measure was 100,000. But they also had a receivable of 15,000 at the end of the year, meaning that there was a sale that was made, but the collection has not yet been made. So what do we do with that 15,000? Do we add it or do we subtract it? Again, pause if you're not sure. We're going to jump right into it, and we add it. All right, so you add the 15,000 because, again, that's accrual-based revenue that has not yet been recognized as cash, or has not been collected as cash. And so the accrual-based revenue would be 115,000 in 2019. 2020, try that one on your own. Again, pause and try to do 2020 on your own. I'll just give you one little hint. They kind of get you coming and going in 2020. That's the only hint. And you can say, so go ahead and pause, and then kind of pick the video up. So 2 adjustments when we talk about 2020. So we start again with our cash-based measure. Now there was a collection. So with this 15,000 in 2019, we're going to assume that it was collected then in the following year. So we record it in 2019 and then we collect it in 2020. At the same time, you have 18,500 that was recorded as a receivable in 2020, but it's likely going to be collected in 2021. And so essentially there's this dual adjustment. And so when you think about that 135, that includes this 15,000 that should not be accrual-based revenue. It also does not include 18,500 that should be included. And so what you do is you subtract the 15 and then you add the 18. And so the accrual-based measure of revenue for 2020 would be 138,500. And then the final slide, or the final calculation, hopefully is one that you're going to get here on your own. But again, pause, see if you can get it. But hopefully by now this one's not too bad. And again, you start with your 156. And again, there's this collection of 18,500. And then there's the weight to collect of the 19,100. And so similarly, you're going to subtract the collection from the prior year, and you're going to add the accrued revenue that's not going to be collected until 2022. And that process would go on and on and on and on. Again, that's just sort of giving you an example of the difference between cash-based accounting for revenue and accrual-based accounting for revenue. And I think that's it. And indeed it is. So we will stop sharing there, and hopefully this is helpful, and see you soon.